Today, I'm going to show you the exact structure that I use to pay my mortgage off faster than the 30-year term that I have signed up for. But before we get started, hit the like button, subscribe to the channel. It really helps with the discoverability of my content to be able to help as many people as I possibly can. We're going to jump straight into the information here. So, how to pay your mortgage off quicker. It is the question that everyone wants to know the answer to. And no, this isn't going to be some sort of special hack where you can pay your mortgage off in 7 years. That is for a very niche scenario. This here is to show you the structure and discipline you need to pay it off faster. So, saving money and time on your mortgage is nothing more than structure and discipline. You don't need to be earning more money, you just need to know how your features work on your mortgage. As a mortgage broker, you might think that it's my goal to get you in as much debt as humanly possible, but I don't actually want you to stay in debt. It is my mission and hope that you will pay your mortgage off as quickly as humanly possible. And now, before we get into all of the nitty-gritty, there is an important note you must understand. Interest is calculated daily. This fact fundamentally underlines the basis of the strategy that we are going to map out. An example on the strategy is, on a $500,000 loan, $100 a week strategically placed can reduce your loan term by 8 years and save you $182,000 in interest. Paying your mortgage off early isn't about smashing it down with your tax return or a massive bonus, although it helps. Just like investing, your results come from discipline. If you systematically put money towards your investments, over time, that will naturally grow. That is the old dollar cost averaging method. The more you put in on a more frequent basis, the less important the buy-in cost is when it comes to investing. But this is not an investing video. This is how you can pay your mortgage off faster. It's about setting up a structure that works for you in the background every single day. If this structure is working for you every day, I promise you, you will pay your mortgage off faster than the 30-year term. How much faster? Well, that's going to be up to you and how you do this. So when we start off with the structure, we need to understand the fundamentals of bank accounts. A high interest savings account, you can forget about that. Earning interest is a taxable event. Saving interest, that is tax-free, and that's really important. This is by far one of the most powerful pieces of knowledge to support the structure that we want to put in place for you. So, as an example, if you had $30,000 at 4% interest earned over 12 months, you would have $1,200 minus your 30% tax rate here in Australia, you would earn $900 net. But if you had $500,000 and you're paying at a 5.7% interest rate, which is very average at the moment or at the time of filming this video, over 12 months, the interest you will pay is $28,500. And with $30,000 in offset, you would then pay $26,790 because you're only paying interest on $470,000. This is a tax-free net saving of $1,710. Now, yes, someone is going to say, well, aren't we going to compound the interest and aren't we going to amortize the debt over the course of 12 months? This is just to show you the brief maths on how this works and that when you go ahead and save money, it's going to work faster for you because this tax-free saving, this is going towards paying down your principal, so that's going to compound it at a faster rate, and this is how you pay your mortgage off faster. Next, we are going to get into the structure, and because structure is everything, and this is the exact system that I use to pay my mortgage down faster than the 30-year term. So, my salary will enter into offset number 1. From offset number 1, I'm then allocating my money. My money then gets allocated out to offset 2, which I have for bills and direct debits, and then off to number 3, which is for my discretionary spending. The level above this is to have a credit card that also runs off this as well. So you use your credit card for your monthly spending. At the end of the month, you pay it back with offset number 3, and then everyone's happy. No one pays any interest to the credit card companies, but you need to build discipline and structure first before you introduce a variable that could quite potentially cost you thousands of dollars in interest, which is your credit card. But let's go back to the top. Where your salary enters, that is offset 1. This is where your mortgage is paid from. That way, this is essentially on autopilot. What I do is make sure there is enough money for the minimum mortgage repayment. Then, after I've allocated all of my direct debits and my discretionary spending, I have done it in a way that I have money left over to sit in offset 1, and I'm systematically building up that offset balance. The way that I did this is to make sure that I had a goal in mind to pay my mortgage down. And essentially what I'm doing here is saying, well, I'm going to need, let's call it $200 a week inside of this offset account to pay it down faster than I want. So what I do is make sure I have $200 more than what I require for my mortgage repayment going into this offset account on a weekly basis. To make this structure work, automating it is the key. As we have already discussed, all of these accounts should be set up as offset accounts, and lots of banks offer this at the moment, and if they don't, we will go through what you can do a little bit further down without having to refinance. So it's important because your interest payable, so what you pay in interest at the end of every single month, is calculated on a daily basis. You need to allocate your funds for your mortgage payment plus your extra contribution, then disperse the funds to the other accounts after this. It should happen on the day after payday, okay? Say you get paid on a Thursday, on Friday, you should have automatic payments already set up so you don't even have to lift a finger, it does it all for you. The hack for success that I found at the beginning of my journey with this is that I was lacking a little bit of discipline when it came to offset number one, because as we were contributing more money into that offset account, it was rising at a rate that was quite fast. And you know what? When you have more money that you have access to, you kind of want to spend it. And I get it. So discipline is the number one trait to make this successful. If you don't have discipline, you need to manufacture it, which is what I did. Over time, offset one will grow in value, and you want to avoid using it for anything it is designed for. So, this might sound a little silly, I want you to remove offset one from the dashboard view in your banking app. That way, you can't see it. If you can't see that bank account, you are less likely to spend that money. You obviously understand that you can spend that money and you have access to it whenever you need it. However, if it's not front of mind, you're not going to spend it. This would mean that your mortgage repayments will be on autopilot. So you should only check it once a month just before your mortgage repayment to make sure you have enough in there. And if you're following the right structure, you definitely will. Okay? This is your silent wealth builder that you can deploy at a later stage. This is going to be a whole nother video altogether on what you can do once you build up that massive offset balance and the strategies you can use to invest that money further and reduce your debt at the same time. Now, before anyone comes at me in the comments, fortnightly repayments are not the silver bullet. I've always maintained the mentality that fortnightly repayments are for those who lack structure and discipline. Sure, it adds extra mortgage repayments per year, but offsetting correctly will yield a stronger result because you are putting money towards that mortgage every single day, week, however you are paid. You need to make every dollar count, and that's why a structured offset system will always be best for you. However, I then start getting asked one of the most important questions: redraw or an offset account? And I understand there's a lot of conjecture online about this, but I don't have anything inherently against a redraw facility. In fact, this is the next level to actually implement if you're struggling with your discipline. The issue is that a redraw account is the bank controlling the money and not you. I prefer the offset as the extra funds are working the same as if they are in a redraw account, but they're never actually entering the loan account, which is an important distinguishing factor when it comes to the purpose of your loan, which we'll cover in just a second. Having funds in your offset account means you have all of the flexibility and you never change the purpose of your loan. This can cause a tax problem, which mainly comes about when you're turning your principal place of residence into an investment, which is a common strategy for a lot of Australians. So I would encourage you to use your offset facility if you're unsure what you're going to be doing with this property when you're ready to move on. If you are steadfast on the fact that you will be selling it, no questions asked, then a redraw facility is okay for you to use because it doesn't matter if you change the purpose of a principal place of residence loan, because it's all about what you do to the tax deductibility of the debt. So without getting into a pure accounting video, I think keep the money outside of your redraw account if you can help it. Now I know what you might be saying. David, what about the offset fee? Yes, most offset functions come with an annual fee, the most expensive of which are about $395 a year, but don't need that much in offset to make up that difference. So there's a formula for this, so you can do this with your own accounts. Your offset balance needs to equal the annual package divided by your interest rate. So 395 divided by 5.7% means you would need at least $6,929.82 inside of your offset account to ensure that you're saving $395 per year on the annual package fee. This is a pretty standard formula that you can apply to your own scenario. I prefer to go with a low cost lender. There are ones out there that will only charge about $8 a month, which is $96 a year, $300 cheaper than the example presented in front of us. This is one of the biggest reasons why it's important to understand the fees and charges to see if it's going to be worth it for you. If you're not going to have anywhere near the $7,000 inside of your offset account, then you shouldn't be opening up a mortgage that has a $395 a year package fee, because you're just going to be more out of pocket. If you're going to use your features correctly and actually use them to their full potential, this $395 is just the cost you pay to play the game. Now, let's do a bit of an example in action, right? Let's say we have a $500,000 loan with a rate of 5.7% and a 30-year loan term, a very average loan size, average interest rate, and standard loan term. Regular offset contributions of $500, this should say per month, starting from $0 in your offset account, will actually save you 8 years and 11 months on your mortgage. The line drops off here because at this moment here, your loan will be fully offset, and then if you so please, you can actually pay your loan off completely in full. You do have options to have the mortgage repayments come principal only out of that offset account, so essentially you don't have to spend all of that money upfront paying the mortgage off. You'd have enough in your offset account here, like we've said, to pay off your loan in just over 21 years. And this is from $500 per month. So the key takeaway, I don't care what you spend your money on, as long as you adhere to the structure first. Fund your offset, pay your mortgage, then spend whatever you have left over. Organize your money and understand where things go, and you will pay your mortgage off a lot faster than you might think. But what comes next? We're not going to get into it in this video. Once you've created some cash inside of your offset account, you need to decide what your plan is to build wealth. There are multiple strategies you can do. Once you get to the position where you have a fully offset home loan, there are things you can do to turn this debt into deductible debt, but this is going to be a concept for another video. For now, all you need to do is adhere to some sort of structure. If you enjoyed this video, hit the like button. It really helps the discoverability of the channel and really encourages me to keep making this sort of content. If you want to know anything else further, please reach out to me or just drop a comment and I'll make sure I make a video on that.